Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Aleksey Chernobelskiy. He advises passive investors on existing and future investments and is the founder of GPLP Match, a platform that allows LPs to see deals that match their specific investment criteria. Additionally, he writes weekly to 7,000 investors on his website, lplessons.co, to explain how to properly vet and consider LP investments in the grand scheme of their portfolios. Prior to advising LPs, he ran Store Capital's $10 billion commercial real estate portfolio and oversaw the firm's underwriting team. So thank you so much for being on the show today.
Hey, thanks for having me. It's nice to be here.
So you have a very interesting background before getting involved with what you're doing now, which is also very interesting. Can you tell us a little bit about yourself personally and professionally and prior to just what led you into the real estate space?
Yeah, I was doing all types of investing before. Really all types of investing with the exception of real estate, to be honest. Started in algorithmic trading, did some distressed debt, turnarounds. Basically touched a lot of different worlds. And then when I moved to Arizona, I joined Store Capital. It's the most recent experience that you mentioned. That was sort of my introduction to real estate. And also, I was lucky to do it at the institutional level. Obviously, this was not my firm. It was a REIT that I was a part of. I was an employee. And, had an amazing experience. Happy to chat through it if it would be helpful. And then left and started what I'm doing now.
So can you tell us a little bit about what Store Capital is, what kind of REIT it is, the real estate investment trust, kind of what is their asset classes they're focusing on, and kind of... I know we touched that you were doing underwriting there, but if you can kind of go in a little bit more depth of what your role was there.
Sure. So a REIT is a real estate investment trust. There are public REITs and private REITs. For now, I'll talk about public REITs, i.e. they're traded on some exchange. We were a public REIT. STORE stands for Single Tenant Operating Real Estate, which basically means we bought single tenant buildings where the operations, that's the operating part, was like the key component of that business being in that property. So just to give you an examples, by the time I left, I want to say we had like 2,900 properties, give or take, across the US. We typically bought somewhere between $1 billion to $2 billion a year. Average check size is surprisingly small, like probably like 10 to 15 million each, right? But we did a lot of volume. It was a fascinating experience. In terms of my role specifically, I ran two separate teams, but they were like very related in that anytime a deal came in, so a salesperson would find the deal, it would come through my department to underwrite the deal. Like I managed a team of 20 people that underwrote across a ton of different industries. We had like over 100 different industries, if I can recall that correctly. And once a property would close, it would go to closing. Once it would close, then it would come back to my team to manage, which was the portfolio management group. And I had a bunch of people as well. They'd get the same 20 people sort of floated between underwriting and portfolio management as necessary.
What were some of your main takeaways from working at a publicly traded REIT?
I'll tell you one that's, I think, very relevant to LPs and GPs is I actually wrote an article about it a few days ago, maybe a few weeks ago. I think I labeled the article "Deal Flow Rules the World." It's a little tongue-in-cheek, right? But one of the things that I saw and honestly didn't really appreciate at the time was we're a public REIT. We had like, I think $1 billion or $2 billion on a revolver that we could pull at any point. Like essentially like for all intents and purposes, like an endless amount of cash. Right. And what that meant is when someone thought of a sale leaseback, which is what we did, like a single tenant building type of acquisition, one of the first three thoughts that would pop into their head is like, man, I really hope like maybe Store should buy it. Like they're easy to deal with. They don't need debt. They're not going to give a debt contingency, right? And so because of that, and there's a bunch of other reasons, but like because of that, we just got a ton of deal flow. Like I think on an average week, my team was probably underwriting between 5 to 20 deals. That's an average week. And that means that's after the salesperson thought it was interesting enough to underwrite, and they probably went through, 10 to 20 to 30 deals to get to one of those. You get what I mean? So I think that's just like a very important principle for both the GP side and the LP side, which I think LPs don't appreciate that enough. It's like they see a deal that like falls into their lap, and they're just like, oh, like, okay, like I should invest before someone else does. And it's the first deal I've ever seen. And it's like, I don't know. Not sure.
Yeah, it's that makes perfect sense. It's like, so you have 400, 500 a week of deals that your team is looking at. As you're saying it, 20 of them are getting to kind of underwriting stage, like a full underwriting stage, and you might be closing on a very small percentage of those. So it's really, you're like less than 1% on deals you're really closing that you're really sorting through to find something that really checks all the boxes on your underwriting.
Yeah, like it's a pretty intense process, and I think it should be that way. And the only way to stay competitive while rejecting so many deals is being able to close. Like, meaning if people, the counterparty, whether that being the seller or the broker that's involved, know that when they pick up a phone and call you, you're going to be honest with them and you're going to be quick on response times, regardless of your decision, right? That builds credibility. And over time, like, you just naturally start getting more and more and more. And as long as you're being transparent with people, and even if you're rejecting, like you said, like 90%, 95%, whatever the number is, people still have tremendous respect for like the speed and the transparency that you give them.
Yeah, that's for sure. Every time I talk to brokers and they're weeding out new investors, it's always their, for example, it's something like, they don't respond. They send a deal, they never hear back, goes into the black hole, and the people weren't serious about buying and they never hear back. But if you write back with some sort of, so many times I've been thanked for just writing back like, no, it doesn't fit like these, bullet point 3 things, like something quickly we saw, you know what I mean? And you're done with it. But most people don't do that apparently. So it's put you above the rest of the pile. One thing that you kind of glossed over really quickly there that we haven't really spoken much on the show about was at Store Capital, what you guys were kind of providing a service, and that was a sale leaseback, which obviously what you're doing is in the name of what the term is. But can you explain a little bit about what that is and why a company would bring in Store Capital to assist them with that?
Sure. I think the easiest way to think about a sale leaseback is it's a form of leverage, right? But it's an alternative to your bank loan, right? So you have a business, for simplicity's sake, let's say you run a childcare with like 10 locations. You want to grow to 30 locations within the next 2 years, right? And so all of your real estate currently has mortgages on it. And let's say, for the sake of example, all of it is 70% loan to value, right? So that means you have 30% equity tied up in those buildings, right? And in the meantime, you want to grow, right? So Store had a solution for both of those things, right? So on your existing portfolio, in other words, even if you don't want to grow, we could cash you out of, let's call it 100% loan to value, which is just we own the building outright for whatever the value is. With the proceeds, obviously, you pay off the existing loans. That 30% is now yours. And you can do whatever you want with it. You can reinvest it into the business, grow the footprint. You could, buy Bitcoin if you want, not investment advice. So that's like solution one. In other words, it's really like liquidity at a much higher loan to value number, in a sense, that a mortgage would never provide, right? And in the meantime, we write like somewhere between a 15 to 20 year lease, which gives you security in the fact that you can stay at the location for a long time and like you're not going to get kicked out, right? So that's on the existing footprint. For future buildings, like if you have a building under contract, so let's say you're buying a business, childcare, down the street, and it's $5 million for the business and the property. And so typically what you would have to do is go to a lender and say, hey, the lender will say, I'm willing to lend, this much on the business and this much on the real estate, right? When you come to us, like we would take the entire real estate footprint down ourselves, right? So we buy the building at close in conjunction with the operator buying the operations. We own that property, lease it to you, right? And then you own the opco, obviously, and you get the benefit of it. And so it's really like, again, just to reiterate, it's like a form of leverage. And if you're either if you need liquidity to diversify your net worth, I think is a good solution, or if you're trying to grow fast, it can be like a very effective way to sort of get your dollars to run out or run more. You know what I mean? You have a much more efficient return on equity because your dollars are not tied in real estate stuff. If you have $1 million and you can invest it in the opco, those returns will be much greater if you do a good job than tying it up in a real estate with like a bank loan. You know what I mean?
Yeah. I also think it simplifies your operations a little bit. You're in the restaurant business and you're in the real estate business because now you own it and now you're just back into fully the restaurant business. And it's now one of those things where you clean up a little bit of your operations as well. Yeah. So your focus, I guess you would say.
Yeah, it helps. I don't think it helps maybe as much as you're saying. The leases are triple net. So like if there's issues with the buildings, you still have to deal with them. So like I don't want to overstate that part, but there's some truth to that. Like it's beneficial to, for example, like have one landlord where you're sending one check per month as opposed to like 10, right? There's like things like that. Like you can partner with your landlord to like add on to your building, for example. We did all types of stuff like that. If you have a new acquisition, you don't need to call, 10 local lenders. You just call us and, again, like we basically had like endless liquidity. So, yeah.
Oh, that's a great business plan.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So kind of moving forward, can you tell us a little bit about what you're doing now and tell us about LP Lessons, why you launched it, and what you do there?
Yeah. So what I do now is advise LPs. That is on the existing investment side and future investments. In other words, if an LP has an existing investment that they need feedback on in terms of valuation, capital call, whatever it may be, I give that feedback. If they have a new investment that they're considering and they want feedback, I do that as well. LP Lessons really started, I guess, getting close to 18 months ago. As a result of a lot of people just telling me like, hey, I've been following you on LinkedIn, Twitter, like you have a lot of interesting things to say, but I'm not an LP yet, or I'm not liquid currently. But I just want to learn, like, is there a place for me to go to learn more about things that you're seeing in the market and whatever. And so that's how I started it. I started it to basically give people LP lessons. that was the exact, I guess, idea behind the title. And, day to day, I speak to a lot of LPs. Some have really good stories. Some, unfortunately, have really sad stories, right? And the whole premise is if I can keep the confidentiality, right, of those conversations, anonymize them in a way that still helps other LPs avoid those types of problems in the future, like I think that's pretty cool. If I can sort of do that at scale. And yeah, so I mean, that's how it started.
Yeah, no, it's a fantastic business and kind of a assistance that you're providing to LPs. It's not really out there that much. One of the things for people that have passively invested in real estate over the last few years, it's been for many of those investors kind of a bumpy ride and kind of littered with some unexpected capital calls. How do passive investors assess the decision to invest in a capital call? And how would you do that if someone came out to you and explained to you?
Yeah, good questions. I'll start with the basics. I think the first question, you're going to laugh at some of this stuff, but like, first of all, you should make sure that you have the money. Okay. Like I've had people call and they're like, should I borrow on my 401k in order to meet this capital call? I'm so scared of this email. Like, I don't want to have a foreclosure. And, jokes aside, like, I think sometimes GPs don't understand fully, like, the emotions that an LP goes through when they get one of those emails, and they don't, half of them, give or take, don't understand that losing money was a possibility. In other words, when you speak to retail LPs, it's not uncommon for them to say something along the lines of, well, I thought the worst thing that the worst thing that can happen is I just get my money back and don't get a return. So like, okay, I'll just get my money back. You just sell the property and you pay off the loan. What's the big deal? Right? But of course, it's not how, unfortunately, that's not how things work. And there's a lot to investments and risk, right? Back to capital calls. I think the most important thing to figure out, there's really a few, and I've written I think 7 articles at this point on capital calls alone, because how do I say this nicely? Sometimes they're slightly deceptive. And by the way, just while we're on the topic, one of the reasons why they might be deceptive is because there could be a misalignment of interest between the GP and the LP at the time the capital call comes. Meaning the LP and the GP might have very different incentives. And the more distressed the property gets, the more those incentives get misaligned, right? And of course, this is putting ethics aside, right? You hope people act ethically and they are above the board. But just in practice, I can tell you, sometimes that doesn't happen. Okay. In terms of just like steps to think through on capital calls, again, the very basic step is just making sure that you have the money, right? The second step is like, what happens if I don't invest? Right? Like, you'd be surprised how many times that's not clear. Like, is there a dilution penalty? Is there no penalty? And you just get diluted by the new investors that come in, which is very logical. Like, if you need more equity, you get diluted. That's normal, right? What's the security type, right, of this new investment? Is it debt, and therefore it's senior to what you're doing previously, right, which was equity, I'm assuming, or is it the same equity that's pari passu, i.e., the same, let's call it, as your original equity? A few other things just to quickly to consider is, will this be the last capital call, right? Like, how likely is it, based on what you know about the property and the debt and the maturities coming up, is that like the GP will call you in 6 months and be like, oh, hey, like, thanks for helping us. Like, things are doing great, but we need more money, right? And I've seen that, like, and to be clear, nothing wrong with that. But the beautiful thing about real estate is your deadlines. You know your deadlines years in advance, usually, unless you like hit a covenant or something, right? So, and the last thing I'll add, there you can tell there's like really, like, we could do a whole podcast on capital calls, but the last thing I'll just add is, like, you should probably have a decent understanding of where your existing money sits. Like, if they were to sell the property today, realistically speaking, what's happening with the cash? Is this a capital call where you have a realistic chance of getting your money back, right? Or is this a capital call where you might get your marginal capital call money back, but you basically have zero chance of getting the original money back? I'll take questions now.
That's a lot of great information. One thing,
Right, that was a lot.
no, it's fine. As an LP investor, I've gotten hit with 2 capital calls. We've never had one with any of our GP deals. Well, with the LP deals, one thing I've always seen is like, the use of funds and finding out kind of where those are going. And one I invested in, one I didn't. Because you kind of see how much money is going back in just like GP's pockets that were funding part of it or something like this. Sometimes they have capital calls and some of it's going to repay loans that the GPs were putting out to the property. You know what I mean? Not so much going back to the property, which is not really what you want to see. I don't want to see. So
I actually think that topic is very intricate. I wrote like a whole long article on this because technically speaking, and we can move on if you'd like, I just want to make a quick note. Like, technically speaking, the GP did not need to fund that money, right? So you could understand how the GP could argue, like, what do you mean you care about paying me back? I didn't have to fund that money in the first place, right? And I think that's a reasonable take from the GP's perspective. Now, from the LP perspective, in other words, let's do a simple example. Like, the GP funds whatever capital is necessary, and a week later, they send you a capital call. And part of the uses is to pay them back. Do you care? Probably not, right? It's like they just funded it when they needed it at the moment, right? And they just basically fronted the cash. But it's clear that like they're in communication and they're telling you what's going on. And they need to get paid back. Like they weren't supposed to put the money in, right? It's not their job, so to speak, right? Now, if I told you like a year passes and all of a sudden you get like, an email, it's like, hey, we need a capital call. Oh, by the way, like in the uses, there's like miscellaneous expenses for $10 million. And you're like, hey, what is that? They're like, oh, we're just paying ourselves back. Oh, you lent a loan? Like you sent a loan out to this property? Oh, yeah, we did that like a year ago. Oh, and like in the past year, you've been sending us reports saying everything is fine while you're funding capital losses. Like, so you get what I'm saying? At some point, like the way that I phrase this in the article is like partnership goes both ways, right? And so if you're being transparent about funding it first, I think in some sense LP should actually appreciate that. You're funding a gap, but the key is transparency. Like you have to be transparent at the time that you actually funded that loan. And don't be shady about like, the uses. I see that all the time. Like half the time the sources and uses aren't even there. The other half of the time, like, it'll be some like pseudo name and it's not clear where the money is going. So people have to ask, so.
Yeah, no, and the one I did fund, it was one of those things where, 80% was going back to property in one way or fashion or to pay down some debt, and 20% or so was going back to LPs or to the GPs, and it was clearly stated. So I did fund that. It's just, with another sponsor, they weren't as transparent, let's just say, as they should have been as the first one. But so kind of moving forward to people that are investing for the first time as an LP, or maybe they're trying to fine tune like their investment philosophy around LP investing, what would you say are some strategies for LPs to, avoid common investment mistakes other than, a lack of transparency at deal level when you're looking at a property or a deal?
I think the first place to start is actually not the property. And I've been like trying to sort of preach this for a while, and I think some LPs are still not totally understanding it. I think people think when I'm investing in a property as an LP, the most important thing to look into is the property. And I deeply disagree with that. In fact, I have a 3-pillar system, and the last and therefore least important, it's not that it's not important, it's just the least important, is the property. And the other two that come before that is like, who are you investing in? Do they know what they're doing? Have they done this before? Right? What's the alignment of interest looking like? Right? Between the fees, the waterfall structure that's put in place, and the co-invest from the GP, right? And then once you get through those two things, then you start like actually analyzing the property. And I can tell you just from, advising a ton of LPs, many investments don't get to step 3. like probably 7 out of 10 deals that I look at, it's hard to get to like the pro forma. It's really hard. Like you have so many questions on the first 2 steps where maybe people aren't being honest about their track record. Maybe like they're overstating their level of experience. Like there's so many questions before you get to the pro forma itself that you're just like, well, let me see how they answer these things. And I might not even get to the model.
Right. What's some of the best ways? I mean, vetting deal operators. I mean, that can be before we even get into the deal itself, like you were saying, what are some of the ways of like, other than speaking to previous investors, which can be, if you're getting the names from the GP, that can be difficult. Yeah. What other ways would you suggest to someone, vet a deal sponsor?
I think it's important to remember that you're vetting honesty, right? That's actually what you're vetting, I think. And you're sorry, 2 things: experience and honesty. Those 2 are separate things, right? So let's speak about both. So in terms of experience, if you get the sense that like the experience section is being overstated, like for example, you notice that they have 20 exits, and then you Google one of those exits and you notice that like they weren't the GP on that exit. Perhaps they were a co-GP through a feeder fund, or perhaps they were an LP. Now, I always like to say this, and I really believe it's true. All experience is helpful, but it's not the same, right? And so if I'm presented a deck and you make it appear as if you sold all these deals as the main GP, and it turns out that 9 out of 10 of them, you were like, a $50,000 LP investor, then it's, by the way, I've seen that many times. Like, it's like, well, like, what are we doing here? Like, it becomes super hard to trust the counterparty when like the basic facts are, I don't want to say being lied about. It's not false that they were involved in those deals, but they're like deceptive. You get what I'm saying? And so anytime you see or sniff, so to speak, any level of deception, like I think you just like got to put the deck down and probably not look at them again, right? Because you will never understand how the counterparty reacts to things, and the best smell test is in the beginning, like. How do they present themselves? Are they honest? Once you already invest, things rarely get better. They either stay the same or get worse.
That makes perfect sense. So there's different structures out there for people that are doing type of investments that they might see, and they might gloss over some of the stuff when they're reading through, like you said, a pitch deck. And one of the big differences I've seen sometimes is explaining like the differences between return on capital versus return of capital structures, and how this can impact investors' returns on that specific deal.
Yeah. So let's start on return of capital, meaning like the clause in the waterfall that typically comes after the pref. A typical waterfall will go pref first, return of capital second, and then, that the split between the GP and LP hits. I wrote an article that literally says something along the lines of, I think it says, don't budge on return of capital, something like that. And basically the idea there is, if you're looking at a deal, a real estate deal, a syndication that does not have a return of capital clause in the doc, you should just like literally run for the hills, because it does. There are exceptions to this, but it's like 99.9% accurate. In other words, it's very difficult to make sense of a case where an LP puts up, let's call it 90 to 95% of the capital, but the profit share is not after that capital is returned. Like the risk reward profile for the LP is so unhealthy at that point that like it's almost impossible to bring a deal that would make sense. And so that's why I take such a hard stance on that. I generally don't take so many hard stances, by the way. But on that particular thing I do. And then return on capital, as you said, is just like the returns that you're making, right? Like which can be measured on like cash on cash. You can measure it through like multiples. Sometimes people look at averages, whatever you like, whatever your preference is. But there I would just remind people that you really have to make sure that you're looking at net returns to the LP. And if any GPs are listening, try to make that clear. Like, don't just put IRR, clarify whether that's a, deal level IRR or an LP IRR, because there's a big difference sometimes.
Right. Like a net versus a gross kind of to investor.
Yeah. And by the way, both are fine. I think net is more useful to an LP to make a decision. But I'm just saying, just be transparent to which one you're showing.
Yeah. The other thing I want to, you talked about there is does it make a big difference when you're reviewing a deal if it's going to be a levered or unlevered kind of IRR return on that? Or is that not as important to the investor, I guess, just knowing how much debt's in the deal?
I think the level of debt is important. I think once you go to like levered versus unlevered IRRs, you just lose people. Like, the most retail LPs are making decisions. I just tweeted about this yesterday. Like, I think we've lost it, so to speak, with like these decks where it's like, here are your 6 investment options, and each one has like a different fee level. And like, if you invest this much, you get, 5% more of the upside. It's just confusing, man. Like, sometimes I look at these decks myself and I spend like 10 minutes trying to understand something and I still don't get it. Then I look at the PPM and I still don't get it. And then I reach out to the sponsor. And it's like, if I'm having such a hard time, like, listen, I'm not the smartest person, but like, like how is someone, between surgeries, so to speak, supposed to make a decision when things are so unnecessarily complex? You know what I mean?
Yeah. It's like choosing an insurance policy or something and you're going through all this stuff.
Oh yeah. Don't get me started.
So talking about presentations, this is one thing that I found a lot. And the amount of times I've had, like you said, PPMs, the private placement memorandum, the legal documents not matching with actual investment decks, I mean, it's pretty numerous. I don't look anywhere near as many as you do. What are some of the top like misleading information that you might find common in these investment presentations that people should really take a second glance at when they're going through them? Because I think that's high level what people are really... I think the PPM, not many people are really reading that as in depth, but I think they really spend a lot of time on those pitch deck presentations.
I think the single biggest surprise is usually fees. And it almost never borders on like illegal stuff, meaning it's not necessarily that they told you they're going to charge 2% acquisition fee, and you open up the PPM and it says 5. Now, have I seen that happen? Yes. But I'm just saying that's pretty rare because that's just like, it's pretty egregious, right? Now, what I have seen is like, I'm going to call it deceptive behavior, which is the deck, for example, makes it seem like acquisition fee 0, asset management fee 0. And then there's like, I don't know, I've seen all types of decks like this. And then it's like other GPs, like 3%, 2%. And you're like sitting there as an LP, it's like, wow, like this is pretty awesome. And then you wire the cash. And then one day you open the PPM and you're like, oh, there was a 10% disposition fee. Right? And you're like, oh, so that's why you didn't have any fees. Okay, now here's where it gets like really nasty is like, what happens if the investment doesn't perform? They still get the disposition fee, right? That comes out before the waterfall hits, right? So, I don't make the rules. You know what I'm saying? It's just like, I think there's a level of like transparency that I think generally is missing in the marketplace. And people just have to look out for themselves.
So for someone that's seen a lot of different sponsors and deals out there, and one thing I guess I always hear people really complain about is like reporting. And myself as a passive investor on a lot of deals as well, it's something that I always, not always, but I'm continually asking for additional information from some of the GPs that they might not be as detailed on the reporting as possible. For you, I mean, what type of reporting should LPs really be looking forward to receiving, let's say, on a monthly and or on a quarterly basis? What do you want to see from your investments when you've invested?
Sure. So anyone who wants like a detailed answer, I have an article called Minimum Viable Reporting Package. There's another one, by the way, called Minimum Viable Capital Call, another one called Minimum Viable Deck. You know, like I wrote a whole series on, I guess, my thoughts on a lot of these topics. But in terms of reporting package, I think my simplest guidance is just like, think about what matters to the LP, okay? And be honest with yourself. That's the hard part, right? Because I'll just give you an example. Like, what's the number one thing that the LP cares about? I think that's pretty obvious. Like, yeah, like, how's my investment doing? Right? Now, what most GPs will do is don't give an answer to that, right, directly. You'll like go around and suggest, you'll suggest
you're moving in the right
different
direction.
Topics. Yeah, you'll like suggest different topics and hope that the LPs
piece it together.
Pieces it together, and they're like, wow, things are great.
We painted the building, there's a new roof on it.
Yeah, exactly. And we made a dog park, right? And we did this, and we did this, and here's a picture of the puppies and like our holiday party. And like, look, like all of those are really nice. It's nice to keep your investors updated. It's good for investments. It's good for your new investments. Do it. But like, don't lose track of what actually matters, right? What matters is like, what did you promise them in terms of the pro forma in year one? And how's that going against what happened in year one, right? Like basic stuff, right? How have cap rates changed since I invested in this? Like, you know, something traded 200 basis points of the cap rate that we entered at 2 months ago, but I don't know about it. You know about it, right? But maybe I should know about it because we're a partner, right? You know, and again, I want to be clear, like these are difficult topics because it's very easy to deliver great news, but it's much harder to deliver difficult news. But my point is just like quality over quantity, big time. As an LP, I would much rather get an update every 6 months than get pictures of dog parks every month. You know, and by the way, I'm making fun of that, but like there's so many iterations of that it's like, oh, like occupancy is great, okay, but you didn't tell me that you're giving 3 months off. You know what I'm saying? So like, there's so many iterations of this that's like you paint a certain picture, you hope that the LP comes to a conclusion that like things are going well, but you're really not. You're not providing the answer that they really want.
Yeah, that makes perfect sense. I guess when it's filled with a lot of pictures and a lot of information, which is great that, I mean, they're proactive and they're going through. I guess all of this is just to show that they're moving through their business plan and you're just, stuff's going the right direction, even if there's a variance between, you know, budget and what you actually actuals are, you know what I mean? But I guess that's what I really seen. We have a couple minutes left here. I have 2 questions left for you before people learn about your company more. And this is one thing that we kind of spoke about a little bit before in regards to kind of who's running the deal. And I think over the last several years, I've seen a lot of deal operators, syndicators take on and vertically integrate property management with their firm. And every time I'll ask them, if anybody's listened to the show for a while, I mean, I always ask people about the pros and cons. I've done that, and you get a whole different number of answers. But I'm also not really adverse to third-party management of properties when I invest. It doesn't give me too much more, I guess, comfort in knowing that they're doing the property management versus someone that might have 15,000 units in the area that's doing the property management. What is your take on, you know, firms that are doing their own property management?
Sensitive topic, but I'm going to tell you what I think. I think probably in the vast majority of cases, it's a marketing tactic. In other words, people, i.e. GPs, want to tell LPs that we're vertically integrated and we have 1,000 employees, or whatever the number is, like something impressive, right? And like look at this person on site that I hired him 2 years ago, and he is our maintenance guy, and so on and so forth. And by the way, it has a real impact. Like there's truth to it. Now, if you're asking me from a pure investment perspective, I think the answer is pretty clear. And if the GPs are honest about what they know about the economics, especially when you're just getting started, it is like an extremely bad idea to do internal property management. Like it's an extremely, I'll say it like this. At best, it's a very inefficient operation. At worst, you're actually costing LPs money. Like, and again, at some point you scale up and it makes sense, fine, right? But I think that for the vast majority of syndicators, at least like, let's call it in the first 3 years, obviously it depends on scale, but it just doesn't make sense.
Yeah. It's a difficult, low margin business, and it's difficult to do it right. I self-managed my properties for 6 years, and it's a lot of work. It's a lot of work. It's a thankless job, but that's why I always, when I see people doing it, it doesn't push me one way or the other. But you have people you talk to, and I invested in this deal, and that's something they throw out there in their bullet points to you. You know what I mean? And you kind of gloss over that. But all right, as we're finishing up here, how can our listeners learn more about you and your business, LP Lessons?
Yeah, sure. So, I mean, lplessons.co is the blog. I think as of this morning, I think it was like 7,500 investors that get my weekly updates. For any of those that are listening and they are either a GP looking for capital or they're LPs and they're looking for deals, I encourage them to go to gplpmatch.com, which I just started like a month ago. And it's basically free service to both sides of the network. And, it sounds exactly like it's named, which is, GPs submit deals and they match with LPs. LPs get notifications and they reach out to the GP. It's like pretty simple. And obviously, if anyone wants to reach out, I welcome all hellos. And it's pretty easy to find me on LinkedIn and Twitter.
Okay. Well, thank you so much for coming on today. Looking forward to connecting with you in the near future. And we'll put all the links down in the show notes. So thanks again.
Awesome. Thank you, man.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.